Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us here in late September for this version of the Market Carver. We've got just 3 points to you. We try to, as often as we can, to keep it simple and reach you, give you the main points. So we're going to start off talking with multiples. This is going to be in the fundamental and valuation territory, but couple that with interest rates and how they correlate. We're going to look at the updated technicals and a real important chart that Andrew shows us each and every week. And we try to show you, say, once every month or maybe 6 or 8 weeks. We're at another point where it's critical to share with you. And then we're also going to take a look at sentiment and just really historically where we are. That I don't think will surprise any of you when you see it or think about the conversations you have with your friends and neighbors. But we'll get into the charts on that in just a second. I'll start us off talking about multiples and real yields. So just taking a step back to explain what real yields are. So often when we're looking at interest rates, whether it's on a 10-year treasury or on a CD, we're just looking simply at the interest rate that they're paying us. Meanwhile, what really matters is the interest rate after inflation is to take it into account. So often we're looking at real yield to give us a better indication of where what an investor is really earning on his or her savings. And so that is the light blue. And then Andrew on here, I didn't see the look on his face, but I'm sure somewhere deep down, because I know him so well, he is calling out the chart crime here of using 2 different shades of blue. Not the favorite way to differentiate between the lines, but it's not our chart. We're just thankful to be able to use it here. But so the light blue version is the real yield, and it's inverted. So actually, as it's gone up from -1%, where we spent most of 2021 and the very early parts of 2022, we were up in that -1%. So that chart has come down, which indicates a rise in real yield. What that has done has very clearly been a part or a force. It's not the only force, but a major force behind multiples, or the amount that we're willing to pay per dollar of earnings on the S&P 500. That relationship has come down. And in fact, the real yields have just kept going. The bond market is continuing to respond to the reality that the Fed has got a lot more work to do, and therefore that has meant higher real yields. In this case, 1% after you account for inflation, and that still leaves a little bit of a gap or a little bit of area for the forward multiple to catch up, which would indicate it coming down a little bit. If I were to take a step back and to look at this chart, I would see a couple of things. Number one, we were able to spend a lot of time a couple of years ago at 21, 22, 23 times earnings on the S&P 500. That was a good, great environment, but clearly a part of that was that we just had interest rates too low for too long, and that was a good environment. Best guess now is that we spend more time in positive territory, whether that's 0 or 1 or 2, and that by historical relationship indicates a lower multiple. 13 maybe at the worst end, but 14, 15, 16 would be historically speaking, a more average multiple. And that just leaves more work for the earnings part of the equation to be done for S&P 500 to move higher over time. So that's this fundamental and valuation-oriented outlook. Andrew, take us into the short term and update us, if you would, on the S&P 500 and its daily price chart.
Yeah, Adam always knows. I don't understand why some banks will use different shades. Some will do different shades of gray. So you have a full color palette. You'll know it's a chart that I've made when it pops up here on the screen, because I use the full color spectrum when I start plotting charts. Look at all that. Look at rainbow colors. Let's dive into it. This is just a simple S&P 500 S&P 500 daily chart. Each one of these, they're called candles, represent one trading day. And the trend has been, for the most part, down. This chart looks at from March through September. And what's important, if we really zoom in on that far right section, I know there's a lot of lines on here. There's a lot going on, so I do apologize for that. What stands out when I see this chart is there's a theme that traditionally follows different bull markets and bear markets. In bull markets, we see levels of support hold up and levels of resistance don't, meaning stocks find support, buyers come in, and when we get to a resistance level, those buyers push right through it and we see price go higher because it's the bulls, it's the buyers that have control. The opposite is true when we're in a bear market. In a bear market, we see resistance levels are respected and support levels are ignored. And that's what we're seeing right now. We can see the price ran up from that June low, went all the way up to that kind of yellow line, which is the 280 moving average, came right to a halting stop when we hit it. That's a very widely tracked moving average. All the technicians are plotting that on their charts, ran right up to it, gave a little kiss, and then came right back down. And then every step down since then, since that mid-August high, we've actually seen every level of support keeps breaking. We got to the 50-day moving average, it broke. Here most recently, we got to 3,900, was believed to be an important price level, bounced on it a couple times, and then as of last week, we broke through it, and we're continuing to see a little bit more downside potentially this week. We have a lot of news, so maybe by the time this video gets released on Thursday, that's no longer the case. But we're seeing resistance level respected and support levels broken as this market continues to kind of digest a lot of the selling that's been taking place. And when we have a lot of that, when we're in that downtrend, that type of bear market, what typically happens is sentiment gets really bad. People see that their investment accounts maybe aren't performing like they had over the last couple of years. The stocks that had done so well, Apple, Amazon, maybe are struggling a little bit. And we start seeing that the impact of inflation also has a material impact on consumers. When they start spending more on their electricity bills, they're spending more at the gas station, the grocery store. They're just not as excited, not as giddy as they might have been. And so we're seeing that show up in a lot of the sentiment data. A lot of the families are talking to our advisors saying, everything I see in the news is really bad. Is that how you feel it too? And that's kind of their own anecdotal sentiment towards what's going on in the economy and the market. And we can actually plot this statistically, quantitatively, based off a survey done by the University of Michigan. They've been doing this for a long, long time. This chart goes all the way back over 30 years. Actually, I think it goes back almost 50 years. This version does. And we can see that the blue line is plotting consumer confidence. How confident is the consumer? And the way they do this survey is they ask, how confident are you about your own personal financial situation over, I believe it's the next 6 months. And we can see that the level's gotten really, really low. It's actually one of the lowest levels in quite a while. But what stands out to us when we look long term, we always want to remember we're focused on the long term, that when we get sentiment this low, look at the other times that blue line has intersected with that horizontal green line. Did the market continue to go down a lot more from there over the next several years, or do we finally see maybe a possible durable bounce higher? We saw very, very low sentiment at the end of 2008. The market did continue to go down lower for a couple more months, but over the next several years, we saw a very strong equity market. Similar to going back to the 1970s, when we also had a lot of inflation, when we finally saw that washout in consumer confidence, no one was happy about the market or the economy. We finally saw the market kind of bottom out. And for the next several years, one of the strongest bull markets in history was the result of that. And so, yes, right now sentiment is pretty low, it's very, very poor. People aren't very bullish, aren't very excited. But from an investor standpoint, if someone has a long time to invest, multiple years at least, that's what they want to see. They want to see where everyone's kind of thrown the baby out with the bathwater, everyone's kind of abandoned the market. And those are great signs for contrarian investors. And right now, we're not necessarily saying that we're at the absolute low today, but when we look several years ahead, we think that this low level sentiment is actually a positive sign. And so hopefully the data will begin to support this. We start seeing price. That first chart that I showed you with all the colorful lines starts to turn higher, and we can start adjusting our portfolios as well to hopefully benefit from that. But sentiment right now, one of the lowest levels, largely because of inflation, what the stock market's doing. Thankfully, the labor markets continue to be strong. That is one bright spot we can point to. The labor market continues to still hold up well. A lot of the unemployment rate still is fairly low. But consumer confidence across the board, one of the lowest levels we've seen in quite a while.
Yeah, I couldn't agree more with that. And just to echo something you said in there, it's one thing that's been true over time is the market has always turned first. Well, and often months before you see anything that is good news. And that is just so important to keep in mind. I don't know if that's going to be another month or 2 months, but I couldn't agree with you more that the sentiment out there, we hear it in our conversations. And I'm sure you guys watching it do as well. So In any event, we do appreciate you giving us a few minutes of your time and spending it like you do so often on these market carvers. We thank you for that, keeping glued into our thinking. And don't forget, you have the opportunity to come in and see us. If you're new to FEG, it's a complimentary meeting. The first meeting is on us. So give us a call, 800-928-4001, or scan the QR code and book it electronically. So thank you so much and have a great weekend.